Assalamu alaikum. In today's video, I want to speak a little bit about monetary risk versus conceptual risk because I feel like monetary risk is spoken about a lot, that you should only risk 1% of your trade, and you should, or like you should risk 1% per trade, 1% of your account. But conceptual risk is not a spoken a lot about, so to speak. In today's video, I'm going to speak a little bit about conceptual risk and monetary risk, how both of them work. I've been trying to research consolidation, and I have come to the conclusion that every consolidation can be divided into three categories: early phase, middle phase, and last phase. Early phase is when the market is entering the consolidation and the levels are not very clear, something like this, maybe. The middle phase is when the market is consolidating. This is a very wild, volatile consolidation. Let's not consider this. Let's go for something simple like SPX, which stays in consolidation for very, very long. It's been consolidating for 6 November to 27 February and then broke out. So, or if you like go longer, even this is the consolidation phase. Anyway, my point is that a market stays in a consolidation a lot. It's one of the most recurring f- phases or themes you will see in the market compared to trends or breakouts and whatnot. So let's first speak about the early phases of consolidation. Let's first get rid of all of these lines. Delete. Or actually, I can't because I might need that in tomorrow's analysis. So I'll not get rid of those lines. Instead, I'll do what? Replay. Mm, this thing will not work then. Actually, you know what? Let me just make a quick video because it's not like anyone's gonna watch this. So I'll just show what I've been thinking. It's uh yeah, during the early phase, for example, something like this, the levels are not clear. When the market has gapped down from this 208 level, the market has opened lower. It broke a very important consolidation area. The market was consolidating in this area. It finally broke down. When you were entering here, when you were trading this day, the risk you are taking is not knowing the levels where this market is going to go. In like days like these, you know the levels. You know that the market is going to turn off of 200. But on days like these, you don't know if the market will turn off of 200 or not. So the play changes throughout the phase of the consolidation. Of course, this is a very bad example of consolidation, but my point is that as the consolidation continues, initially the play is about the levels, but slowly the levels become more known. For example, I'll take the example that I am trading right now currently, that I traded this past week. For example, Tesla. Initially, the levels were not known. Initially, the play was about how Tesla behaves in this area, but slowly levels became more clear, more defined. 333 became more defined. 350 became more defined. That there are sellers here, that there are buyers here. So in beginning, the moves were a lot cleaner. You would see a very clean jump of 333. The moment stock touches 333, the stock goes up. The moment the stock touches 350, the stock goes down. But slowly the market has become more choppy. Like, you can see here very clean bounces, and slowly now it's going everywhere to everywhere in this area. It's like jumping off of anywhere. It's not clean anymore. You understand? The stock loses. This 282 was important, but then the stock disrespected this level like multiple times, and slowly 282 lost its value. And the play changes. The market still is under consolidation, the levels still are important, but the play has changed. That is what I mean by conceptual risk. I will watch my video. I really, really hope I'm being clear on what I'm speaking about. So every trade you take, there is a conceptual risk. For example, when Tesla entered here, the conceptual risk you were taking is that based on my analysis and blah blah blah, and the way the market has moved in the past and the way the market is going to be moving today, depending on the news that has come out, bearish or bullish or whatever, I think that Tesla is going to hold the 330 level, 333 level, and Tesla is going to resist 350 level. But Tesla is being strong and it's rising and it's bullish, so it will go up. And you make your own analysis. You have a concept. You every day you trade a concept. If you do not have a concept, you should not basically trade. So when you are trading this concept, if your concept is wrong, you are going to take a loss. If your concept is right, you win. You make profit. So you get paid for being right about the concept that you are trading. You understand? The monetary risk is separate. But if your concept is correct, you make money. If your concept is wrong, you lose money. So initially, during the early phases of consolidation, the concept is to figure out the right levels. You do not know the levels. But during the later stages of consolidation, as the levels become more defined, the play is not about the level anymore. The play is about the traders who are sitting at those levels, how they're perceiving that level, how they will be, how they will be played, how they will be gamed at those levels. What are the games at the important levels? You will stop seeing clean reversals at these levels now. You will start seeing fake outs, you will start seeing stop hunts, you will start seeing liquidity pools. You will start seeing all these kind of weird activities. People are paying attention to these levels now. So the game is not the level anymore. The game initially, during the early stage of the consolidation, the game was the level. But during the later stage of the consolidation, during the second stage, after like 3-4 days, you can see that the early stage is 1 2 3 4 4, I think 5 days. And then 1 2 3, this is the second stage. Here the moves are very clean. Here they were not. You can see a lot of muddiness. You can see the prices being very very erratic, very unclean. So the concept remains the same, that in the buyer zone there are buyers, in the seller zone there are sellers, but there is slight haphazardness, there is slight confusion. So my and of course I'm going to try and research and try to understand how the play changes into the second consolidation, because I'm beginning to think that second consolidation phase is my weakness. So I'm going to research more of that, see what are the plays in these kind of areas, because that might give me hints towards where the market might break out. Trying to understand the second phase consolidation is important. My strong play is first phase consolidation. But it's important to understand that it's important to understand conceptual risk. You might be thinking that you're over trading, revenge trading, and that's why you are losing money, but your concept might be wrong entirely, and you're blaming your emotions. So I'll quickly show you what I discussed with DeepSeek. I He frames it very well. This is straightforward. Is the amount of capital you are willing to lose on a trade. It's quantifiable. This is more abstract. It's the risk associated with the validity of the trading concept or idea you're applying. For example, if you're trading based on idea that price will bounce off support level, the conceptual risk is that your understanding of support levels, or this specific one, is flawed or incomplete. If it is flawed or incomplete, if your plan was to buy at 333 and for some reason you get stopped out, you lose money, or this level is broken, your understanding of that level was not complete, of the 333 level was not complete. There was some mistake, something you missed, something you did not incorporate, and you paid the price for not considering it. Is So you're paid, i.e. profit, for being correct about the concept, and you lose if the concept fails. This is separate from monetary risk, because even a good concept can lose due to noise, but a bad concept will lose systematically. So you need to understand if you failed because you were being emotional, or was the concept wrong entirely. You're supposed to understand that. Early phase of consolidation, unclear levels. At the start of the consolidation, the market is chaotic or range bound without clear support or resistance levels. The conceptual risk here is high because You are trying to discover or define these levels, and your method for doing so might be wrong. Example, using the wrong time frame, misreading order flow, or overfitting past data, which is very, very possible. Your trades are essentially hypotheses. I think this is a level where price might reverse because so and so reason, so and so reason, whatever your reason is, whatever the narrative that you are building is, uh, and your narrative might be completely different to to the narrative that the market follows that specific day at least, and it's completely possible. Example, you see a range forming after a trend and guess that that the midpoint might act as a support. You buy there, but price slices through it because the real support is lower. Your concept midpoint as support was wrong, not just your trade. So you try to you need to accept that and maybe try another day, or if you're like really good, maybe you can come up with a new concept instantly, or maybe you have a backup concept in place, that if this does not happen, that means that means this, and if it means this, then this is going to be my new concept, or this is going to be my new trade plan. You understand? So every concept can have a backup concept. A later phase of consolidation, clear levels. After some time, the market establishes clearer support resistance levels. Example, through repeated tests. Now everyone can see these levels, so the edge shifts. The concept of price will bounce at X is now obvious. So simply trading the level isn't enough. The edge comes from understand who is at these levels. Example, weak hands, retail traders, blah 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 versus strong hands, stop hunts, liquidity pools, and how they'll act. The conceptual risk changes. Now it's not about whether the level exists, but about whether the participants at the level will behave as you expect. Will the buyers step in aggressively, or will the sellers break this level? Or will there be slow accumulation today? Will the stocks be slowly distributed today? The the play changes. It's slightly harder. I feel like the second phase of consolidation is slightly harder. The problem I am likely getting at is, once levels are clear, the market often games them. For example, market makers might run stops below support before reversing. Liquidity grabs or false breakouts become common. Your edge isn't technical analysis, everyone sees the same levels, but understanding microstructure, who is there and why. Like who is where and why. This is where many traders fail. They keep trading the levels mechanically without adapting to the fact that the conceptual risk has shifted from finding levels to predicting participant behavior at known levels. Would you like to like deep? And then I was discussing that why isn't this more talked about? And um, yeah, this is very important. Misattribution of losses. Most traders blame losses on poor execution, emotional trading, or bad luck, not the core concept. They might say, I didn't follow my plan, when the real issue was the plan itself was flawed. And maybe that's why you changed the plan midway, because you felt like something was flawed. Even that is completely possible. And yeah, it's not possible to control a conceptual risk. You might be extremely confident on the concept that you are going to be trading today, and then the market does something else entirely which you did not consider, and then you pay heavy price for that. Stress your concept explicitly. Yeah, I like this. Explicitly define your edge. Why should this work? I'm fading liquidity gaps because so and so reason. My consolidation breakout strategy fails in low more. For example, yeah, this is the condition under which your concept is working. You should know when it's working, when it's not working. The market is not going to be the same every day. You need to keep track of the news. What is the news that promoted your concept? What is the news that trades against your concept? How does the SPX behave when your concept works, or like what kind of behavior you want SPX to show for your concept to work? So every day is going to be different, and every day you're going to need a new concept, and every day you trade that concept. Bigger picture, blah blah blah. And then I wanted to read more about it, which I will do later, inshallah, if I get the chance. But there's something I wanted to share with you, something I thought was very, very important. uh Inshallah, I'll continue working on this over the next week. I'll try to develop or polish more my concepts a little bit more. It's gonna need some research. I might have to set in back test. I will see how my idea behaves over the past trading data, and you will see me in future videos. You will see how I'm performing. But inshallah, this is I'll keep discussing as long as I find something new. I'll discuss that. Inshallah, inshallah. Okay. Anyway, see you tomorrow. The market is closed today, even though it's Monday. The market is closed for Memorial Day. So I will see everyone tomorrow where I'll trade. Ma salama.